on here?
The market is hostage to headlines right now, unlike any point I can remember in my career. Probably thinking about this from a broad trading range perspective is probably the best way to think about it for me. So think about getting back to that February peak for the S&P 500 and then getting back to or below where we were at the worst of the tariff-related news earlier.
That's Willie Delwich, founder and investment strategist at High Mount Research. And he says that what's going on is a range-bound market, toggling between record highs and the April lows. And which way it breaks out will determine a lot about how confident an investor can feel about good or bad news moving forward. But up first today, Michael Grant, portfolio manager at Calamos Long Short Equity and Dynamic Income Trust. He'll be talking about how this environment impacts income investors, which is a great segue to our market call, where Eric Lutton, co-chief investment officer at Sound Income Strategies, manager of the Sound Enhanced Fixed Income ETF, talks about generating income with BDCs, REITs, and more. Happy Friday, everybody. This is Money Life for June the 6th. We're glad you're here. June the 6th means it's 1 week until my birthday. Not that we're going to spend a lot of time celebrating or anything else. We're not going to do that. But yeah, I know you got to count them and everything else. To me, it's very different. Somebody was asking me the other day where I'd said, hey, we were scheduling an interview for my birthday. And they're like, hey, that's a great thing. And I'm like, yeah, when I was a kid, we had birthday week. My mom's birthday would have been Monday the 9th. One of my grandmothers would have been Wednesday the 11th. I'm the 13th. My other grandmother was the 14th. And so you'd have parties throughout. I mean, it was sort of hard to not have some sort of celebration. And even if it wasn't your birthday the day of the celebration, everyone was celebrating everybody. And of course, now all those folks are gone. So my birthday can be very quiet. It's not like I'm turning a landmark number or anything. That is not the case. But most importantly, the good news is I feel great, like physically. And those of you who know, and several of you have asked how the Wegovy journey is going. And I have lost somewhere north of 20 pounds very comfortably and easily, feeling better, made it through lacrosse season healthy for the most part and not really having any problems. Occasionally you have little muscle twitches, but that's not a weight thing. That's a did I stretch enough thing for me usually. Lacrosse season will basically wrap up this weekend, last of the youth games and a jamboree on Sunday. So moving on to the summer, excited for that. And I don't know that I'm excited about the market, even though the market is kind of trying to push towards record highs. The market seems to be finding that the path of least resistance is upward. And that's not a bad thing. We certainly can't complain about it, but really interesting today as we really dig in on the income side with two different interviews that are very much focused on income. Michael Grant and Eric Lutton. Eric Lutton makes his debut in the market call. And I will say, I love your opinions when we bring somebody in, especially someone you haven't heard before, like they were great, bring them back. Yeah, maybe not so much. There are definitely things where somebody who's never done the market call before has to kind of learn how to do it. And so you go, if you had a good debut, do you get a better one as the follow-up? And typically you do. At the same time, sometimes you have a bad first appearance and you kind of go, yep, maybe not worth the next one. That happens as well. So I'd love to know what you think. Chuck at moneylifeshow.com is how you reach me. Market today, it's going to be really interesting to see how it reacts to jobs data because that's what's coming out. I think we're expecting a bit of a bounce. And the rest of the numbers, we're going to try to stay away from the politics stuff and stay into the market. But of course, as you heard Willie Delwich say in that clip, the market is being held hostage to headlines right now. We're not held hostage to it, but we do have to talk about it. So that's what we're going to do. I've told you what's coming. Let's just jump straight into it because we got a great show, but we're going to let the interviews run. Again, Michael Grant for The Navigator, Willie Delwich talking technicals, Eric Lutton with the market call. I'm glad you're here. It's a great day to live the money life. The Navigator kicks us off next.
Dig deep into business development companies at the Active Investment Company Alliance 2025 BDC Forum. It's Wednesday, June 11th in New York City. A full day of big names and BDCs at the podium or on informative panels and networking opportunities with fund sponsors, asset managers, institutional investors, and others who are actively involved in business development companies. Advisors can get 7 CE credits for attending. Go to aicalliance.org/events for the full schedule and details. Use the code NAVIGATOR20 for a 20% discount on your registration fee.
Michael Grant, co-manager of the Calamos Long-Short Equity and Dynamic Income Trust, is here. We're getting his take on where he's finding income in times that are, well, dynamic, maybe. It's time for The Navigator. This is The Navigator, where we talk about all-weather active investing and plotting a course to financial success with the help of closed-end funds. The Navigator is brought to you by the Active Investment Company Alliance, which is a unique industry organization representing the full spectrum of the closed-end fund business, from users and investors to fund sponsors and creators. If you're looking for excellence beyond indexing, the Navigator will point you in the right direction. And today we are looking at the markets and at generating dynamic income with Michael Grant, who is co-chief investment officer and senior portfolio manager at Calamos Investments. He's their head of long-short strategies, and he's co-manager of CPZ. That's the Calamos Long-Short Equity and Dynamic Income Trust. If you want to learn more about Michael, the firm, that closed-end fund, or anything they do at Calamos, go to calamos.com. And to learn more generally about closed-end funds, interval funds, and business development companies, go to the Active Investment Company Alliance website, aicalliance.org. Michael Grant, great to have you back on The Navigator.
It's great to be back, Chuck. Thanks very much.
CPZ is a really interesting fund. You and I talked about it several years ago, and I remember when the fund sort of came out. And let's face it, the conditions in the market and in the bond market several years ago were very different than they are now. This was created to generate income in every market condition. But that was also because we weren't getting any real income and yield out of bonds at that point. Now we have a market that's very different conditions. People are very nervous about the equity side of things, and they are getting paid for the bond market. So start by giving us an understanding of where you see things at right now and how that informs your decisions on where to pursue income.
Thanks very much for having me back, Chuck. So we last spoke in the pre-pandemic era. The setting was a setting where the bond market largely yielded no income. And we launched CPZ as a vehicle to generate income from investors, but to do it without the bond market. We would focus on the equity world. The premise of that related to the mispricing of bonds generally when interest rates were at zero. Our concern was that if we ever went back to a more normal interest rate setting, the capital returns from bonds would be disastrous for investors. And in fact, that's exactly what we've seen. The last 3-4 years, however you measure it, have been some of the worst on record for total return from the bond market ever recorded. So our strategy of generating very competitive income, right, 8-9% annualized income, has been the right one. And we did that without the capital downside of the fixed income markets. Now, the world today is completely different than the pre-pandemic world, primarily because interest rates are now back to normal. You can get a genuine return from bonds, from the bond market. You know, typical risk-free rates are 4 to 5% over 10 years. If you go into slightly higher risk, you can get 6 or 7%. Now, our product still yields a very healthy 8 to 9% annual income. And you might ask, well, now that interest rates are back to normal, what's the purpose of a product that delivers a competitive yield from the equity side? And I would say it's this. Prior to the pandemic, investors owned the bond market often as a hedge against the equity world. In other words, investors believed rightly that in a deflationary setting, if equities got into trouble, bonds would go up in value. So they were a natural hedge that could help to protect client portfolios. Today, that hedge no longer works. In fact, I would argue that the downside risk in terms of capital return can be greater in the bond market than the equity market. So let's look to what happened in April of this year. Trump came out with his Liberation Day, and there was a shock in the equity world. What was the safe haven? Was it bonds? No, bonds did not go up in value. In fact, this was the first time in 30 years where investors perceived an external shock in the equity world, but it did not lead to higher bond prices. The new safe haven was actually gold, not bonds. And the problem with gold is that you don't earn any income. So if you look at CPZ, what you saw was an uncorrelated equity product, uncorrelated to the turmoil in the equity world. That's because we're long and we're short. And yet we were still able to generate the healthy 8 to 9% income. So most of your clients will have a fairly healthy equity exposure of some form. Today, many clients' portfolios are dominated by passive equity exposure, which means they are mirroring the major benchmarks, which means they have boatloads of 7 mega cap stocks. And the question is, how do they hedge that? The biggest problem today is that investors need a product that can deliver equity-like returns, but not correlated to the S&P 500. They already have too much in those big mega caps. And typically, when the equity world gets into trouble, bonds might be your safe haven. That was certainly true pre-pandemic in the deflationary era. Today, that's no longer true because the source of risk for equities today is now inflation, not deflation. In other words, when equities get into trouble, it's just as likely to be because interest rates are going higher or inflation is going higher. So the punchline here is that CPZ, an income generating vehicle that is hedged for your equity risk, is exactly the kind of safe haven product that generates income and that has a real role in your client portfolios.
I want to jump in quickly because I've got so many questions because there's a lot in that answer. And I don't want to get sidetracked, but I obviously part of what you're saying here is something that you can use to hedge off some of your stock risk and your risk on the Mag 7 and the S&P. And yet you do have Microsoft and Alphabet in your holdings, at least the last time I looked. So is it more that you're doing it with other things or it plays that role, even though it also has a small weighting? And I will point out, it's not a big weighting. It's a 2% weighting in those stocks, but it plays out that way, even though you have a small weighting there.
So we're an active mandate and also a mandate that can be hedged. So in the mega caps, we like Microsoft, we like Amazon, we like Google, and right now we like NVIDIA. But we're short Apple, and we've been short Tesla. We have used other index-related instruments to help hedge that mega cap risk. So your typical long-only investor will have an exposure to those mega caps of more than 40% of their US equity exposure. For us, that weighting is typically less than 10%. So that gives you the scale of the difference between what we're doing and what the typical client has exposure to in their long-only portfolios.
One of the things that I have been watching with this market is what I think is mixed messages. I think the stock market is sending one message and the bond market is sending a different message. And the bond market's message, by the way, much darker. But historically, when the two sides disagree on the message they're sending, if I had to say who I'd expect to win, it's usually the bond market. So as somebody who is trying to provide income, potentially hedge not only the equity market, but make it that you have something that is hedging the bond market as well. How do you read those messages, and which side do you think is sending the right message now, stocks or bonds?
Well, I would disagree with you a bit here, Chuck. To say that they disagree means you have to have an idea of what they're messaging. And I would argue that actually the messaging, and let's talk now since April, the messaging has been aligned. And here's how. When Liberation Day came along, investors perceived a shock, the tariff shock. Now, most investors read that as a negative shock for the economy. My view was always that tariffs were a reflationary shock. Reflationary with a very complicated mix of both inflation and deflation impulses. Now, the bond market agreed with my interpretation, right? The bond market did not drive yields to new lows. It was not signaling economic vulnerability. And this is especially true if you looked at credit spreads. So the market was initially unsettled, the equity market, for two reasons, in my view. Number one, the confrontation with China was moving way too fast and it was too broad. Investors were expecting a rivalry with China, not with the entire world. The second risk was the question over inflation and interest rates. Now, when Trump dialed down the escalation, we very quickly saw the market recover. In fact, the recovery was so robust, we really should step back and say, why? What is the market reading, the equity market, that would drive such a fast recovery? And I think the answer is that the Trump agenda today is extremely ambitious. And Donald Trump is operating with democratic constraints. He has a short window of time, 3.5 years at best, maybe less depending upon the midterms. In other words, Donald Trump cannot afford any major economic disruption. And economic disruption means that none of his agenda will get through the front door. I think part of the impressive recovery we've seen in equities is investors understanding that there is a very real put under the economy and under the financial markets here in the United States. Now, how did the bond market read all this? Well, the bond market has pretty much said the same thing. Interest rates are drifting higher, not lower. They are understanding that the impulse here is much more reflationary than deflationary. And of course, as we've shifted from the tariff dialogue to the fiscal policy dialogue, that's become even more apparent. The establishment is doing everything it can to maintain high levels of nominal economic activity, higher for longer. That is the correct interpretation of both the economic fundamentals and I think the outcome for both inflation and interest rates.
It raises so many more questions. Unfortunately, we're out of time. Michael, this has been great. I hope you will come back, and as we watch things play out, we can follow up with you and see again how you're positioning and repositioning and taking advantage of the situation as it changes. Thanks so much for joining me on The Navigator.
Yeah, it's always great, Chuck, and happy to be back. Just I'll sit here and wait for my next invitation.
Michael Grant is co-chief investment officer and senior portfolio manager for Calamos Investments. He heads long-short strategies for the firm and is co-manager of the Calamos Long-Short Equity and Dynamic Income Trust, a closed-end fund trading under ticker symbol CPZ. Learn more about him, the firm, and the fund at calamos.com. Up next on Money Life, I'm talking technicals with Willie Delwich from High Mount Research. Buckle in. It's time for liftoff right after this message. This is Money Life.
Don't get technical with me.
But enough of my technical mumbo-jumbo. Allow me to demonstrate.
Welcome to Talking Technicals here on Money Life. Or no, it's not too hard for anybody to understand if you've got the right experts to talk about it. And one of my favorite people to talk technicals with is joining us today. Willie Delwich is an investment strategist who runs High Mount Research. High, like hello, H-I, High Mount Research, which I'm telling you how to spell it, because if you want to find him, it's highmountresearch.com. And Willie's been coming on the show for years. He's a business professor at Wisconsin Lutheran College in Milwaukee, used to be with Baird and with All-Star Charts, High Mount, his firm, and it's always great to catch up. Willie Delwich, it's been a while. Welcome back to Money Life.
Thanks for having me, Chuck.
You know, the market has had, if we just shut it off since like the last time you and I talked, it's kind of been flat. But in there, we had this super big decline and this super big bounce back. So let's start with your take on where things are now. Like, what's your likelihood of which direction the next move goes and how far?
Yeah, it has been a volatile period for sure. If you've been in the trenches and watching it from a day-to-day, week-to-week perspective. What we didn't have before the decline that we saw earlier this year was a lot of broad strength behind the market anymore. That had kind of petered out at the end of last year. What the decline and then the rally since then has provided has been another breadth thrust. We've seen that surge in participation in the U.S. that suggests that we could move higher for probably the next year or so. Will we continue to do that? Well, that's kind of beyond the scope of technicals, but the market behavior right now certainly suggests that's possible. The other thing we've seen that I want to make sure we touch on is that while we talk a lot about what the U.S. is doing, we're also seeing international leadership, international strength, which is something that most investors, if you look back over the past 10 years, we haven't seen much of that at all. So that's encouraging on two fronts. We see global leadership, and then we also see broad participation within the U.S.
I'm going to get back to broad participation in a moment. I want to stick right now with the international side of things because it's been a very interesting week here on Money Life. I have had a couple of guests who have said they think that the international play is now not necessarily played out, but that international is going to be weaker going forward, that the big rally has happened and that they're expecting the domestic market to do better than they think out of international. And I have had a couple of other guests who have been the other way on that. They have said international is going to continue. That's where you want to be. So help us break that tie, if you will, on the last like 4 or 5 days where it's literally been every day back and forth. Where are you on how well international can do, and especially relative to the U.S.?
Yeah, I mean, it's easy to say that there's room for the international to catch up. You could have said that a year ago. You could have said that 5 years ago. You could have said that a decade ago. And we are at that point where if nothing has changed, then kind of international had its little spurt. And now it's going to be back to U.S. leadership. I think the macro backdrop is a little bit different right now. We're starting to see this rotation out of U.S. equities, out of the U.S. dollar, out of U.S. bonds. So we have this rotation not just from U.S. stocks to international stocks, but I think U.S. assets are leaving the country to some extent. And it is a good time to see further rotation towards international leadership. And what I like about what we're seeing right now isn't that we're seeing international hold up a little bit better in a period of weakness. We're seeing international actually take a leadership role, making new highs, returning to new highs before the U.S. does.
Does the international rally look stronger to you than the U.S. rally? Because the U.S. rally, as you said, broader than it had been before.
Very much so. If we look at the first part of the rally off of that pullback that we had, that tariff-related weakness we had earlier this year, international stuff held up much better, was quicker to return to new highs, and we are seeing broader participation internationally than in the US. One way to think about it, think about the percentage of international markets. So ACWI markets, there's 47 of them. The percentage of them making new highs versus new lows, we've seen in May, 55% of the world finished May at a new high. The US did not. Within the US, we've seen improving trends and broader participation, but we've been slow to see this broad expansion in new highs. And so just from a new high to new low perspective, international has many more markets making new highs than we have, say, industry groups in the US making new highs.
Let's come back to the US because although we don't have industry groups in the US making new highs, you talked about broader participation. That's code or euphemisms for, hey, it's not just going to be the Mag 7. Yet, also this week on Money Life, I've had someone tell me that they thought that the Mag 7 was still going to be the market's biggest sweet spot. So as you're looking at this broadening out, what I haven't had anyone say, and even though you've said a broadening out, you haven't actually used words like small caps. Are we going to finally see the long-awaited small cap rally? Or this is broader, but it's broader basically at the large and maybe the high end of the mid caps?
Yeah, and that's a great point. If you look at where small caps, even mid caps are relative to large caps on a ratio basis, small caps and mid caps are as low as they've been in the past decade and a half relative to large caps. And so we do definitely in the US have large cap leadership. Behind that, we have had enough participation to get these breadth thrusts and improving prospects going forward. Are we seeing strong evidence of small cap and mid cap taking the reins like we're seeing international take the reins of leadership? No, not at this point. And so if you look at some longer term trends for the US, it's still large cap growth that is leading the way. Everyone wants to see value take a leadership position. Probably not everybody. Large cap growth managers want growth to continue to lead, but a lot of people want to see value take a leadership position, want to see small caps and mid caps take a leadership position. It's not happening right now.
You know, that point of everyone wants to see value, except for maybe large cap growth managers, the way that the market has changed because the Mag 7 has gotten so big, the cap sizes have changed. You know, there's only, depending on how you cut it, but the way Morningstar cuts it, there's only 21 large cap growth stocks anyway. And you've got giant companies or what used to be giant companies that are now mid-cap stocks. So I do think everybody's waiting for value to take over because there's a lot more value stocks than there are growth stocks. What would it take for value to come back to the fore? Does it take an economic event more than a market event? Because as long as the market event is, hey, we've got a little momentum, it doesn't seem like value can get ahead.
Yeah, I think that's probably right. Maybe it's a repositioning from a bond yield perspective. Maybe it's an economic perspective. I mean, there's some math in here that makes it hard for anything except large cap growth to lead if the indexes are holding up, because large cap growth, while it's a relatively small number of companies, they represent such a large percentage of the index. So in that respect, the index isn't going to hold up if you've got your Mag 7 are not participating. So we probably need an extended rotation, not an event type rotation.
I'm going to hold off on the event thing and try to get you to give us some numbers, which is currently, as the things exist, as we record this on the 5th of June, where we are in tariff situation and current events. What is support and resistance for you? I mean, how much room have we got to grow when you like the looks of this market? And if you're wrong, what do you think we'd settle in at?
Yeah, I think so. The first threshold for the S&P 500 is get back to a new high. I said already, we've seen international new highs. We've seen the all country world index is right there. We've seen ACWI ex-US making new highs. So I think if we are good, the S&P 500 should be able to reclaim its February peak of around 6,200, 6,100, somewhere around there. From a support perspective, you can think about it from a level, I'd say 5,800. If we break below that on the S&P 500, probably is a sign that things aren't going well. If we break below the 200-day average, which I believe is right around that same area, that also would be evidence that maybe we've got volatility that's going to stick around for a while. We have seen instances in the past where we've had big drawdowns, huge rallies that failed just shy of new highs, and then cascade lower months later. So breaking out to new highs would be the best sign of strength in the market. I mean, new highs are the most bullish thing that stocks can do. And if we see that, that confirms that we are still in a bull market, not just some sort of very protracted, very exaggerated bear market bounce.
I love all that. So now I've got to put the wrinkle in, which is, of course, we're not living entirely in normal times. And I recognize that everything that is tariff related is not technical until it shows up in the charts. But if I then said, okay, give us your best and your worst tariff/economy situation, how much does it change the forecast you just gave us? In other words, if the first thing is to get to new highs, is the best blowing through those new highs and is the worst blowing through those new lows? Like, how much bigger is the range of possibility just based on headlines?
My guess is, and if we go back to maybe not the specific outcome of tariffs, but the idea that the market is hostage to headlines right now, unlike any point I can remember in my career, probably thinking about this from a broad trading range perspective is probably the best way to think about it for me. So think about getting back to that February peak for the S&P 500 and then getting back to or below where we were at the worst of the tariff-related news earlier. I think we're still in this period where we see rotation out of the U.S. And so we start to see the rest of the world take up a leadership mantle like we have not seen over the past decade. Not the rest of the world is all unicorns and roses or whatever it might be, but everyone has crowded into the U.S. If something has changed in the U.S. from a political perspective or from a news perspective, I think at the margin that makes investors a little less complacent to stick around in the U.S.
But that's at the margin. You are not suggesting that whatever we've seen is necessarily going to send folks cascading away or fundamentally changing the way the world views America as an investment.
Well, by what I mean at the margin is that we stop, if you will, having some sort of premium because we're the U.S. And so everyone wants to be in the U.S. I think that starts to decay or has started to decay. And so the leadership possibilities and the benefits that we've seen over the past decade and a half go away. And so think about it more from the U.S. versus the rest of the world than the U.S. on an absolute basis. I don't think we're going to wake up one morning and all of a sudden there's massive capital flight out of the U.S. and that kills the indexes. I think at the margin, people are less willing to buy the U.S. and more willing to buy the rest of the world.
We've talked about the market. We haven't talked about your take on things like gold, which of course has been the hottest asset of the year. It is a hedge, not so much against inflation, at least not the inflation levels we've seen, but certainly against geopolitics. Where are you on assets like gold right now?
Gold's making new highs. Gold is trending higher relative to the S&P 500. If there was a time that you would be interested in gold, this would be the time to have gold in your portfolio. It is an absolute uptrend, and it is trending higher relative to U.S. stocks. Commodities overall are not holding up well. Gold specifically is, and there are periods where you want to have gold. There are periods where you don't want to have gold. This is one of those periods where you want to have gold exposure.
Your take on crypto as a potential asset? Because it's not a commodity and it's not gold.
Yeah, I have fought crypto. Right now, it seems more to be a play on volatility and risk appetite than anything else, as far as I can tell. So if you think that risk appetite is going to be strong in the US, then you probably want to have exposure to crypto. If you don't think that risk appetite in the US, or I guess probably around the world, is going to be strong, crypto's probably not something you're going to be interested in. I would go back to what I said about the S&P 500. The most bullish thing that any asset can do is make a new high. So probably making new highs in crypto would be a signal of persistent strength going forward. And that might be a level for investors if they want to get involved. But I think that reiterates this idea that people get terrified of new highs because we've never been there before. The most bullish thing any asset can do is appreciate in value. And so when you're making new highs, that's a sign of strength, not a sign of weakness.
Willie, great stuff. Always is when we catch up. I look forward to the next conversation already. Thanks so much for joining me on Money Life.
Yeah, thanks for having me, Chuck.
That's Willie Delwich. He's the investment strategist behind High Mount Research. If you want to check out High Mount Research for yourself, highmountresearch.com. Up next on Money Life, it is market call time. Eric Lutton from Sound Income Strategies will be here. If you want to be looking for something safer in these markets, make sure you stick around for that.
Asset managers, you know how hard it is to stand out in this crowded space. Vetify is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, Vetify can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at vetify.com.
Eric Lutton, Co-Chief Investment Officer at Sound Income Strategies, is here. We're talking BDCs, REITs, and income-producing ETFs. Now on the Money Life Market Call. Welcome to the Money Life Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they are putting it all together. Making his debut in the Market Call today, Eric Lutton. He is Co-Chief Investment Officer at Sound Income Strategies. He manages the Sound Enhanced Fixed Income ETF, which is FXED. Now, if you want to learn about the firm, it's soundincomestrategies.com. If you want to learn about the fund, soundetfs.com/FXED, the ticker symbol. Learning about the fund is important because it's an income fund, but it also gets income in other ways. And we're going to be talking about other ways that you can get income, whether it's business development companies, real estate investment trusts, or investing in ETFs that are income producing here. Eric Lutton, it's great to have you here on Money Life.
Thanks for having me, Chuck.
We always start with methodology, and I'm sure I just ham-handed kind of what you do in the brief intro. So help us understand, because your search for income is maybe not the conventional search always for income.
Correct. Our methodology is a little bit different. I'll give you a quick background. Our company, obviously, we're working with retail investors, high net worth individuals, and what we call middle class investors as well, trying to throw off enough income to where their retirement's safe and sound and they don't have to necessarily touch principal. So we've got, to give you a quick background of methodology, we work with a lot of bonds. So, for instance, in bonds, we're trying to determine basically the financial stability of the target company, which all boils down to business risk, as you know, and financial risk. So with business risk, we consider the economic and business cycles. We look at where we're at, industry-specific trends. And then we also do a more bottoms-up approach by reviewing the 10K and the annual quarterlies. So we look at the financials, we listen to earnings calls and talk to management when possible. So we're considering leverage ratios, coverage ratios, liquidity ratios, cash flow ratios when we're trying to assess whether this company is going to be able to pay their interest over the next 18 to 24 months. Another big asset class, preferreds. Similar to bonds, we're looking for too big to fail names in the preferred space, because as you know, in 2008, a lot of those large financial banks and brokerage, the government bailed them out. Not that we like that as taxpayers, but that's kind of what happens in the space. So we look for big, healthy insurance companies, banks, and brokers. And then, of course, as you mentioned earlier in the intro, some I call non-traditional income plays like BDCs and REITs. So similar to bonds, there's several things to consider with BDCs. BDCs, as you know, have to pay out 90% of their taxable earnings as dividends. We also want to look at the net interest income received from their underlying portfolio of loans, because a BDCs basically, think of it as a non-bank bank. They're looking for underlying companies that need loans. Middle market firms are what they're referred to. Now, in a middle market firm, maybe they're too small. Maybe they're making anywhere from 5 to 250 million in EBITDA. Maybe if they need a $50 or $100 million loan, that's too small for Wall Street because they're looking for billion-dollar bond deals. But that's too big for their regional bank. So this is where BDCs come in, work with management, and come up with ways to help finance them and help their management. So when you're looking at net interest income from BDCs, you can look at affiliated versus non-affiliated interest income, fee income. You want to look for a high level of non-affiliated income and lower fee income, just because you don't want there being conflicts of interest. Look for good spreads, obviously, a growing ROE and increasing net asset value over time. We watch the underlying portfolio and see how how their non-accrual bucket increases or decreases with the market and what's going on. Dividend coverage. This is a big one. Net interest income needs to safely cover the BDC's dividend that they pay out quarterly. We look for low PIK income, low non-accruals, and usually a slight premium to NAV. Because when you look at a regular company, you look at the PE ratio. Well, with the BDC, we want to make sure that they're growing all these and that their leverage isn't too bad. BDCs are allowed up to 2 times leverage. You'll hear about that anytime you look up or read up on BDCs. The more conservative companies, BDCs we look for are usually slightly less than 1 time levered to up to maybe 1.25. So that's BDCs in a nutshell. I know it might be drinking from a fire hose, but these are a little different than typical common stocks. Similar, REITs, like BDCs, have to pay out 9% of their taxable earnings as dividends to the shareholders to remain compliant as a REIT. We don't really deal with mortgage REITs, but in equity REITs, you have 11 basic sectors. Traditional factors, cash flow, leverage, coverage ratios, along with GAAP earnings are all important. But like BDCs, REITs are a little bit different. So we have to consider things like FFO, AFFO, or MFFO. And without going too deep in those details, basically think of a traditional company that's producing a good. They'll have depreciation on their property, plant, and equipment, but a REIT, their property is going to appreciate, unlike a traditional company that may have to replace that property, plant, and equipment. So REITs can still write off their depreciation for tax purposes, but they're a little different because obviously that property is going to appreciate, and that depreciation they're writing off, that's a non-cash expense. So they get to add that back. So NAR REIT and IPA, which is, I believe it stands for the Institute for Portfolio Alternatives, they develop these non-GAAP measures like FFO, AFFO, and MFFO to better understand cash flows. So just think of them as like a PE ratio for a non-REIT company. One area I like is triple net lease REITs, meaning the leasee is responsible for paying the taxes and the insurance on the property, along with maintenance and upkeep, which given inflation could be material, like as we've seen the last several years. You'll want to look at annual increases in the rental rates. Obviously, the master lease agreements will show these to say, hey, is this company increasing every year 2 or 3%, or based on CPI or some inflation factor? Are they increasing their revenue, base rents or revenue? Triple net leases can sometimes offer up more predictable cash flows and lower some of the operational risk, provided they have credit-worthy tenants and have a record of paying consistent dividends. You also want to look for a lower payout ratio, something maybe under 80%. So each REIT sector of those 11 main sectors are a little different. Another example, hotels, you'll want to look for the number of properties, the number of hotel rooms, average daily rate that people are paying for those rooms, RevPAR per available room, what they're bringing in, occupancy rates, obviously, and then the hotel EBITDA levels. And then last but not least, same store, same hotel net operating growth income, along with the traditional FFO and AFO data. Bottom line, there's no silver bullet or ratio or factor methodology. We just want to find stable cash flows that have a certain level of predictability given current market conditions.
Given these conditions, for example, hotel REITs, there's talk about people are going to be traveling less with inflation up, et cetera. But even on the BDC side, we have higher interest rates and we've had them for longer. So there's been worries about we'd see more defaults, though we really haven't seen more defaults. So for all of the conditions that people can worry about, are the conditions you're seeing now like normal conditions, good conditions, worrisome conditions?
That's $1 million question. Are tariffs going to push us over? I mean, if you look at traditional factors, leading economic indicators, M2 money supply, the reversal of the inverted yield curve is inverted for, I think, 2 years. All these factors usually pointed towards a recession. But I think after the election, people were assuming this new administration would bring some growth in, maybe some tax relief and get that money to grow more. But the tariffs, I think, are taking away from that. Now, as you know, our economy boils down to whether consumers are buying and selling. The upper middle class and wealthy consumer have been continuing to spend. Is that going to turn? I think if they don't get more tariff contracts signed fairly quickly by this summer, the damage has already started to happen a little bit, where we'll start to see that show up in the numbers in the coming quarters. So as us, as income investors, unlike equity, where you're always looking for that next growth in earnings, that next catalyst to get your earnings per share up, we're looking at the negative things out there that could take away from our income. So while REITs, if you do your homework, there might be a few that work well, but overall, the industry, I think hotel REITs, I believe, are down about, as a group, down 20% year to date. So it has taken a toll. Whether it continues or not will depend on, I think, a lot with tariffs and whether the end consumer feels confident enough to continue spending money. Like I said, that's 2/3 of our economy.
Let's put this to work. Is there a name or two in the REIT side and the BDC side that are poster children for the methodology, that kind of clear examples of this is the kind of thing you like?
One name that comes to mind that I lost favor with me, I did like it several years ago, was Park Hotels. The ticker is PK. Keep in mind that hotels have to deal with, increasing labor costs, low supply of workers, and a slowdown in travel like we saw in COVID and potentially occurring now. And all these things happen at the same time. So with this tariff war, if that's going to keep foreign travelers and even some domestic travel muted, this sector is going to drag down. So Park Hotels specifically, they focused on luxury, full service resort type destinations. When year-end results were released, I believe it was late February, we had already sold PK at the time, but RevPAR had dropped negative 1.4%. Occupancy dropped all the way down to just under 70%. Net income dropped by 61% to $80 million from, I believe it was $110 million before. These are material factors, that continue to push the stock lower. Even in 2023, which was kind of the warning shot, PK handed over keys to their two premier property hotels in San Francisco. Park 55, the other one was Hilton at Union Square. And these were some of the first material signs, I think, that mange and their debt load was becoming an issue.
And let's talk very briefly about the ETFs that you look at, because we are going to include some ETFs as we get into our lightning round here. From the standpoint of the characteristics you want in an income-oriented ETF, are they basically, let's go find a plethora of companies that we would otherwise want to buy, but we'll have them managed another way? Or we're looking at the index and going, this index fits? How do you decide which ETFs meet your income requirements?
In general, ETFs that are producing income, obviously you want to see what sector they're in, how they're generating that income. If it's going to be a true fixed income, is it mostly investment grade? What section of the high yield, if they're utilizing high yield, you're getting your yield from? If you're looking at sovereign debt ETFs, obviously you want to look at the country and how much weight, how many individual bonds they have. If they have too high a weight in certain countries, obviously you probably want to get a little more diversified. When it comes to ETFs in the REIT space, first determine whether you want to deal with mortgage REITs or equity REITs. When it comes to mortgage REITs, you're not dealing with a cash flow producing property like an equity REIT. That might be a hotel or might be single family housing, apartment REITs, or a healthcare REIT. With mortgage REITs, you're kind of betting on whether that management's really good or not at getting a low cost of financing and then playing the spread game by buying mortgage paper. And if they can get a nice spread and they can do that thick and thin, depending on whichever business cycle they're in, then great. That's a little bit harder to do, in my opinion, than choose equity REITs, which are throwing off real cash flow from real properties.
Now we're going to get your quick and dirty take on some stocks and some ETFs that my audience is particularly interested in.
Quick and dirty.
Just go slow and be smart.
Yeah, that's the strategy that basically is in play at Sound Income Strategies. My guest is Eric Lutton. He's co-chief investment officer at the firm that you can learn about at soundincomestrategies.com. Manages the Sound Enhanced Fixed Income ETF, FXED. You can learn about at soundetfs.com/FXED. We'll start on the real estate side of things, then we'll move through with a request we got from Al in Orchard Park, New York. He wants to know about Realty Income. It's ticker symbol O.
Realty Income, it's a huge $58 billion single tenant, triple net lease, what we were talking about earlier before, that has one of the longest and consistently increasing monthly dividends in the sector. I think it's yielding around 5.75% right now. In first quarter, they had solid rental revenue growth of 3%, and year over year was a little over 9%. AFFO growth was 3% over the quarter over quarter, and annually it was up about 10%. Their investment pipeline has grown, but management's giving guidance, I think they've dropped it to around 5% this year versus past growth rates, which are really double digit. And that's got people concerned a little bit. Me personally, I think it's a buy here, especially on a dip, which is why I always like to buy things on dips, obviously. But given their size, it's no wonder their growth has dropped down to 5%. One nice thing, they're increasing their investments outside the United States, and Europe should help. They have a lot of plays in the UK and Ireland, and I believe they're looking at Poland next. The catalyst for this, about 90% of commercial real estate property is held in private hands. O's Realty Income's new private fund called the Core Plus Funds, attracting institutional investors and being able to close on many more deals, because I think they close on less than 10% of the deals that are brought to them right now. So not to mention collecting management fee for starting this new private fund. So I think that's going to give them a little more leverage and a little more ability to increase their revenue.
So that's a buy, particularly on the dips.
Come on, let's buy.
On Realty Income, ticker O. Peter in Wesley Chapel, North Carolina wants to know about Main Street Capital. That's ticker Main.
Main Street, a great BDC, probably a top tier BDC manager, has one of the best growing NAVs and dividend growths in the history of publicly traded BDCs. Main focuses on lower middle market firms versus kind of the upper middle market firms. So they're looking at smaller firms. Smaller firms usually have a little bit lower leverage and a little bit better covenants. So that's a unique space for Main Street. The problem with Main, and the reason I'm going to give it a hold, is because just their premium, their price to NAV is just a little too high right now for my liking. You're at 1.7 times, 1.3, even 1.45 for a top premier firm like Main Street's good, but 1.7 is getting a little expensive.
So hold it if you've got it, but you're not buying more, at least not at current levels, on Main Street Capital. Ticker symbol, Main, M-A-I-N.
No money changes hands today.
John in Fort Worth, Texas gets our next request. It's for Hercules Capital, HTGC.
Hercules, another top tier BDC, excellent management. I believe it's yielding about 9% right now. It's another, just like Main Street, it's another internally managed BDC, which gives them a little cost advantage without having to go to external managers and pay additional fees. About 93% to first lien debt, 5% equity bucket, and 2% to warrants. Well-covered dividends, 125%. I believe 40 cents the base dividend, 8% is their specialty dividend. Again, great company. But again, like Main Street, unfortunately, it's too much of a good thing. Right now, their price to NAV is also 1.7%. So I would want to look for that to come down a little bit and buy. But, you know, it might not come down. But if we do go into recession, we'll see an opportunity. And I would definitely pick up more.
I'm just taking my time before making the move.
Yeah, it's not a buy right now, but you're looking for a better price on Hercules, ticker HTGC. Now let's move over to ETFs. Stan in Driftwood, Texas wants to know about the XLU. That's the Utilities Select Sector Spider.
Well, as we go into recession, utilities, healthcare, consumer staples, these are the areas to be in. Again, I would buy these on dips. I would call this a defensive play, given that situation, given the geopolitical risk, wars, all the things that could be coming at the market even further down the road. But utilities are great. I think XLU is a good play. I would go with the buy. Also look for any kind of other utility ETFs that might have a little bit better Sharpe ratio or something that might play well.
That's a buy on the XLU, the Utilities Select Sector Spider.
Buy it outright.
And last, for Mike in South Boston, it's the IVV, the iShares Core S&P 500 Fund.
Sure. iShares, excellent company, excellent IVV. I've used it many times in the past, and we're investing in it now. This is a very low cost S&P 500 index fund. I think it only costs like 3 basis points. Again, I would look to buy on dips because markets are still volatile. I don't think we're out of the woods yet, but if we do get a slowdown in inflation or a material increase in unemployment numbers and GDP, then it gives the Fed some ammunition to lower the Fed funds rate late in the third, possibly fourth quarter. And this will be a benefit to markets. So again, look for dips in the S&P to buy IVV.
And so while people are talking about what the market could or might do,
Please do not overdramatize these proceedings.
You don't have to overdramatize it. That was a buy on the dips on the iShares Core S&P 500 ETF IVV. And speaking of goodbyes, we have to say our goodbyes to Eric Lutton. But Eric, I really appreciate the time. Thank you so much for joining me on the show.
Thank you for having me, Chuck.
Eric Lutton is Co-Chief Investment Officer at Sound Income Strategies. SoundIncomeStrategies.com, SoundETFs.com/FXED if you want to learn about the Sound Enhanced Fixed Income ETF. And we'll be back to wrap up this week. We'll give you a preview of what's coming next week before we cross the finish line after this message.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
So it's another week already.
Yep. The weeks keep rolling by, and yes, basically this weekend will be the end of my lacrosse season, but we've got some fun things planned for the weekend. I hope you do too. And we've got fun things planned for you next week. Now, we had a bunch of different guests this week. We have the whole thing with all the international stocks and where we've had significant disagreement on what folks are thinking. We've got great things planned for you next week, including Joe Quinlan, head of market strategy for Merrill Lynch and Bank of America Private Bank. He will be here. Stephen Aiken from Aiken Investments makes his debut in the market call. By the way, let me know what you thought of Eric Lutton. A little bit different when you're definitely focused on income the way he was, with the emphasis on BDCs and REITs. But some of you like it when we have the specialty things, and we had plenty of requests that way. Also coming next week, Bernie Horn from Polaris Global Value, Christopher Zook from CAS Investments. We've got Adam Turnquist, Chief Technical Strategist at LPL Financial, and a lot more. We've added a whole bunch of technical analysts coming in basically throughout the course of the summer. We've been working hard on getting everything booked. I'll have a lot more to tell you about on that front next week. Meanwhile, if you're looking for something to celebrate, well, today is D-Day. And beyond, watching Saving Private Ryan or what have you, that generation, express your appreciation while you can. And if you can't, if you don't know someone who is still living from the greatest generation, do the other side of things. Like spend some time walking through a cemetery, and if you see veteran stones and they are covered or they're starting to get whatever, work on them. I do. I frequently, not all the time, have an edging tool in my car. And if Maho and I are walking through a cemetery, we make sure that we're uncovering a veteran's stone if we see one that's been covered or what have you. Do stuff like that. Beyond that serious stuff, well, I mean, if you could, you'd see Saving Private Ryan or any sort of military movie at a drive-in movie today because it's National Drive-In Movie Day. It is also National Higher Education Day. It is National Gardening Exercise Day, which is not like National Gardening Day. It's like gardening for exercise. Okay. It's National Eyewear Day, and it's National Yo-Yo Day. On the food front, it is National Fish and Chips Day in the United Kingdom, but you could celebrate that one here. It is National Donut Day.
Donuts.
It's also National Applesauce Cake and National Churro Day. And applesauce cake and churros kind of feel like donuts to me.
Donuts. Is there anything they can't do?
Yeah, just in a different shape. My guests today were Michael Grant, Portfolio Manager for Calamos. Calamos Long Short Equity and Dynamic Income Trust, calamos.com. Willie Delwich, Investment Strategist at High Mount Research, HIMountResearch.com. And then Eric Lutton from Sound Income Strategies, soundincomestrategies.com, soundetfs.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Jimmy Buffett, who said, "It's important to have as much fun as possible while we're here. It balances out the times when the minefield of life explodes." Well, the minefield of life has certainly been going off a lot lately, so go out and have as much fun as possible while you can this weekend. Relax, take it easy, spend time with your loved ones doing fun stuff. Keep money in perspective, and remember, until we do this again the next time, best thing you could do for your money is not worry too much about it. Have a great weekend, everybody. See you Monday.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Oh, behave. Yeah. Yeah, baby. Yeah.